fragrances prepared by these perfumers at Lactone in Istanbul sell all over the world. But their biggest market is the United States.
In the United States, there is a really huge economy. If you cover all, if you think all Europe economy is not even 1.5 state in the United States.
Faced with rising inflation, the US Federal Reserve has raised the cost of borrowing to its highest level in 9 years.
The job market remains strong, the economy continues to expand, and inflation appears to be moving toward the FOMC's 2% longer run goal. As you already know, we decided today to raise the target rate for the federal funds rate by 1/4 percentage point, bringing it to 1.5 to 1 3/4%.
That's delivered an instant hit to currencies in emerging markets, so Lactone's products will seem cheaper to US buyers. But the raw materials the company uses will now cost more, and significantly raising the cost of borrowing in Turkey to strengthen its currency may not be an option.
The money is very expensive. When you borrow it from bank or when you take it from the finance industry, it's very expensive in Turkey. If you look at in Europe, in United States, it's really cheap.
Higher interest rates in the US attract investors away from emerging economies, depreciating their currencies. And a high dependence on the imports of energy and raw materials means businesses in Turkey don't want to see the lira fall too far. Even exporters who stand to benefit from a weak Turkish lira say the strength of the economy lies in domestic demand, and they hope the central bank can act quickly to make sure the loss in the currency's value against the US dollar doesn't spark spiraling inflation.
The most advantageous thing for Turkish economy is the internal demand of Turkish people, which is a very important driver. So the only thing that we have to do, if we have this precious thing, is just to control the inflation.
Turkey's own central bank is expected to announce its new monetary policy next month. And it will likely be as mindful of the direction set by the US Federal Reserve as the country's businesses and consumers are. Mobin Nasir, TRT World, Istanbul.
We're going to go around the rest of the world now for more reaction to the Fed's move. Let's start in Asia. Joel Labi sent this report from Hong Kong.
Well, it's not as if this rate rise were unexpected, but the region has been digesting it in different ways, particularly here in Hong Kong, which really plays follow the leader when it comes to US money market movements. The de facto central bank here also raising interest rates by 25 basis points to 2%. The fallout from this, though, the Hong Kong dollar plunging to a fresh 33-year low. Now, it's been pegged to the US dollar since the 80s, and if it weakens below the bottom of its trading band, the central bank is going to automatically start buying up the currency. And the concern here is that this could drastically cool down Hong Kong's red-hot property market, which the economy has really been hanging its hat on lately. Now, China tends to be a little more shielded from any US announcements of this kind, given its tighter monetary controls. That said, though, the markets were lower in anticipation of some harsh new import tariffs from Donald Trump directly targeting products from the mainland. Any trade threat of this nature has had a far bigger impact on Chinese investors in recent weeks than anything that has come from the Federal Reserve. Other regional markets, though, are reading the rates decision and plans for 2 more hikes this year a little differently. South Korea and Japan, for instance, which often have taken their cues from Wall Street, they see the announcements as far less hawkish than anticipated, and that spurred on their bourses. One economist I spoke to said that Hong Kong really is the most exposed of all the regional markets, particularly now, because it has to keep pace with what the US is doing.
We're off to London next, and Amber Austin-Wright has been following the European reaction to the Fed's move.
Well, the guidance from the Fed was a lot softer than many traders had come to expect. We'd been looking at perhaps 4 rate hikes this year, but the comments from Fed Chair Jerome Powell strongly suggest we can expect just 3. In Europe, bank stocks, which would benefit from a stronger pace of rate hikes, slipped 1.1%, with HSBC, ING and UBS among the region's top fallers. But the biggest market impact wasn't on stocks, but on the foreign exchange markets. We saw the dollar fall against the euro and other currencies, although a lot of those gains have been erased since earlier this morning. And the reason for that is the looming trade war that's been sparked by President Trump's tariffs on trade. It's increasingly hard to separate out central bank activity from the growing worries about global trade, and that's as true here in Europe as anywhere else. Added to that, of course, here in London, we had the Bank of England's rate decision too. And while there was no change to policy this time around, the bank has hinted that a rise in May is looking likely. And unlike in the United States, it's not because the UK economy is strong. In many ways, it's just the opposite. And the problem here is inflation, which remains stubbornly above target.
And let's circle back to where the Fed story began. And standing by for us in New York is Caroline Woods. Caroline, great to have you on the show. Tell us a little bit about how ordinary people in the US are coping with rising rates. Are people with mortgages, car loans, starting to feel the squeeze? There have now been 6 rate hikes since 2015, after all.
All right, so Main Street or ordinary people, as you said, they'll definitely feel this interest rate hike, whether it's car shopping or looking to buy a house. They'll have to be prepared to pay a little bit more. People will see a minor impact in their credit card statements in the next few billing cycles, unless, of course, they have cards with fixed rates that don't change for a set period of time. Now, those with adjustable rate mortgages, home equity lines of credit, auto loans, or other loans with variable interest rates, they'll be hit the hardest. When we did the math, we found that an adjustable rate mortgage worth about $500,000 will cost borrowers about $1,250 more this year. Now, fixed rate mortgages are also going to become more expensive, so that could hit the real estate market. It's important to note, though, as has been said, rates are heading even higher this year, with at least 2 more projected. And this latest hike is the 6th one in the cycle. So with wage growth remaining pretty sluggish and household budgets tighter, as we've seen with the latest retail sales figures, it certainly adds up and puts pressure on the consumer.
It certainly does, doesn't it? And I mean, as we've just been hearing, you know, there's potential for a possible trade war. The outlook for the US economy then is starting to possibly look a little weak.
Yeah, I mean, that's the concern, right? That's why the markets are selling off. We have, you know, the tech sell-off, which people are starting to worry about regulation there. We have Trump and China and the trade war. And then we have, you know, as I said, the retail sales data that shows that, you know, people are kind of holding on to their wallets a little bit tighter. So maybe things aren't as good as expected, or as, you know, some of the data shows. Also, as I said, you know, with mortgage rates going up, that could impact, you know, the housing market and how many people are actually shopping for homes.
And quite possibly exacerbating some of the inequalities that already exist in the US economy. Caroline Woods in New York, thank you very much indeed.